ultra deep water Nigeria, until you get right to the far end on the curve, and you've got ultra deep water Angola, which has a break-even price of just under $100 per barrel. And this really is the fundamental case for why we do not believe $30 per barrel is sustainable. Because if it stays at $30 per barrel, almost all of this is not going to get produced. There will be another shortfall. There's no doubt about it. And this slide just looks at OPEX. Essentially, global OPEX per BOE was increasing over the last decade at a rate of 5% per annum. Now, obviously, that's a global average, and that covers lots of variation in the different regions. And the bubbles on this chart essentially show, and they're color-coded. So the red bubbles are where OPEX growth has been greater than 100% over that decade. The sort of bright blue is the growth greater than 60%, and then the sort of light green is growth less than 60%. And this clearly shows that the Middle East, Russia, and USA have experienced the lowest OPEX increase over the last decade. So again, this helps maintain activity in the Middle East. And the white figures in the bubbles are actually the decline over the last year. So again, the Middle East has managed to cut their OPEX by approximately 9%. Now, obviously, some of that has been done to the detriment of the service sector, who are actually being asked to take over the order of 20% price cuts. And they're accepting it because they need the work. They need to keep active. And this is just looking at production. What's happened to production over the last year? Well, OPEC production has actually risen 1.4 million barrels a day. And there's obviously Saudi Arabia, Iraq, Iran, and Libya are wild cards. And you can see the increase there, but obviously some of this might be tempered. Iran has potential to produce a lot more if it can get the foreign investment. But as I've said, at the moment, there isn't the capex to make that foreign investment generally. There will certainly be, if they get the terms right when they're eventually published, there certainly will be an attraction to get into Iran. And part of that attraction lead me into my next slide. This essentially shows our view of how essentially upstream industry achieves growth. And there really are only three ways to do it. The first is through exploration. You actually go out, find and develop reserves, and that adds value and that grows your business. Or you go for discovered resource opportunities. These are opportunities which have already been found, but for whatever reason have not been developed. And you could include Iran in that, you could include Mexico in that. So there are these opportunities that are around, but the issue is I won't say no one. Most people haven't got the money to invest in those. So you have now got a limited market for that. And then the third potential for growth is M&A. And obviously with a low oil price, you'd expect M&A to be the way to do it. But what's actually happened in M&A, this chart shows global annual deal count on the left-hand side. And you can see 2015 was a terrible year for M&A. Deal activity collapsed from 500 plus deals to approximately 300 deals. And the chart on the right shows the annual deal spend. And that doesn't look quite so bad. But if you take out the large deals which have been done, the likes of the Shell and BG deal, which obviously sort of warps that data a little bit, you can see it's an equally spectacular crash in value. So now we've just removed the deals greater than 10 billion barrels, and you can see the deal value has gone from, say, $170 billion down to about $50 billion. So M&A isn't happening. Why is that? Simple. The seller's expectations and the buyer's expectations are just so wide apart. It's sort of irrational, but that's the way it is. Everyone's hoping for that increase in the oil price again, or are failing to accept that it might be lower for longer. Whatever way, M&A isn't happening. Now this chart is essentially Wood Mack's analysis of M&A, and this is one of our sort of famous charts. Everyone seems to like this chart very much. Let me just explain it to you. The red line is the Brent oil price, and this is going from 2006 all the way from 2016. So you see the run-up in the price up to $140 a barrel, the crash for the economic global financial crisis, picking up back again to over $100 a barrel for the period 2011 to 2014, and then the crash down to roughly $30 a barrel. Now, all those sort of pale circles you can see in there, they are M&A deals which we monitor and collect data for. And we look at those M&A deals, we look at the deal price, the actual amount paid for that deal, then we use the Wood Mackenzie data to analyze that deal, to look at, we understand what the production is, we understand what the costs are for these fields, so we can look at what long-term oil price is required to make that field equal the value paid for the deal. So actual price paid for the deal equated to an implied long-term oil price, okay? And then we take the weighted average of all those deals, which is the blue line, and the blue line is just the weighted average implied long-term oil price over time. And you can see if we just look in the 2011 to 2014 period, typically the long-term oil price paid is a discount to the Brent oil price of roughly somewhere between 20% to maybe 25%. You can see the Brent price over that time is averaging something like 105, 110, but the blue line is averaging maybe 80 to 90. So the value of deals done are at a discount, if you like, to the actual oil price at the time. Now, 2 points to note is when deal activity drops, so look at 2008 period, the global economic crisis, you can see that the Brent price drops, but the implied long-term oil price doesn't. Deals still get done at a higher price than the current oil prices. And that's because, as I said, people don't really believe the oil price is going to stay low forever. They believe it's going to come back up. But in that period, sort of 2008, 2009, you can see there was a lag. And there's a lag of about 6 to 9 months when the actual implied long-term oil price dropped, which I had a pointer, but not to worry. So you can see there the blue line, and it just sort of drops as the red line is increasing. So, it does eventually drop, but there is a time lag, and that's important to note. So if we now fast forward to 2014, 2015, you can see the red oil price dropping. There was a blip, which is one particular deal, which causes that dip there. But typically what we're seeing is that the blue line is still around $80 per barrel. So deals are currently being done at $80 per barrel when your oil price is $30 per barrel. Yeah, that's the way it is. And this chart just sort of highlights some of the deals. Because people are expecting the oil price to increase. That's a simple answer. They don't believe it's going to stay low. So when they're doing that deal, they're thinking it's going to be back to $80 per barrel in the long term. Yeah. And this chart essentially sort of shows that. I mean, it's a selected few, but it does show it. So we're looking at here is actual deals done. So you can see, the day, who the buyer was, who the seller was, what the deal value was, what was the price paid, and then what our implied long-term oil price is for that deal. So you can see they're all sort of, apart from the Enoch Dragon one, they're all above $80 per barrel. And Enoch Dragon is pretty close to 80. It's not that far off. So that's the sort of, price which deals are being done at. And it's also borne out by deals which aren't done. So if we look at deals which have been rejected, you can see essentially Woodside tried to buy Oil Search, offered $77 per barrel, and Oil Search didn't take it. Suncor tried to buy Canadian Oil Sands at $67 per barrel. They rejected it. Scepter tried to buy Santos, $69 per barrel, rejected. And Anadarko Apache, we don't know the numbers on that. But maybe it's starting to drop. As I said, remember, there's a time lag, and then the implied long-term oil price will drop if the oil price stays lower for longer. And this is what happened. Suncor increased the, don't know if you all saw that. Suncor were offering $67 per barrel. They then increased their offer to $73, And hey presto, they did the deal. Okay. Then there's the ones which were lucky escapes. Dragon Oil offered $100 per barrel in terms of implied long-term oil price. And fortunately, that was just before the OPEC meeting in November 14. And then they realized after the OPEC meeting, November 14, maybe this wasn't such a good idea and withdrew their offer. So one that sort of got away, if you like. But from Dragon's point of view, very, very, must be sort of breathing a huge sigh of relief. Petra Celtic would probably take a fraction of that price right now. So now focus on the Middle East. The key thing in the Middle East, it's not a very liquid market. There are not many deals. It's nature because there's a lot of NOCs which are dominant in the region. So there's just a much smaller deal set. That's just the way it is. This shows you here that there's only 57 deals done in the last 10 years. Compare that to the world. There's 500 deals done per year in the rest of the world. So it's a very, very small market. And most of these deals have been done in one particular place. 50% were in Iraq, particularly Kurdistan, where you had an influx of smaller players who were finding things who then needed to sell on to the bigger players. And you had an influx of larger companies come in to actually explore and develop the discoveries, appraise and develop the discoveries. The number of deals peaked at 16 in 2012 and declined to 1 in 2015. So, there's definitely potential for things to improve. And the implied long-term oil price averaged $58 per barrel in 2012 and $69 per barrel in 2014. So again, it seems to be the deals are done at a lower price in this region. I haven't really quite got my head around why that is, but I'm working on it. Now this chart shows the Wood Mackenzie deal pipeline, and essentially it's at record levels, which in a way is what you'd expect. M&A is created, so there's a lot of potential buyers, there's a lot of potential sellers out there, if you like, just waiting for the expectations to come together. And the chart on the left shows the number of potential disposals by region, by resource, and the chart on the right shows the number of potential acquisitions by region and resource. And no particular surprise, I don't think North America is the leading region, and essentially in conventionals, tight oil is the leading resource theme. So we can see that going forward, we expect when these expectations come together, there will be a pickup in M&A activity, and you will see a sudden, flurry of it. We're hoping the second half of this year, but let's see what the oil price does. But the market price means that these deals will not come cheap, and this chart essentially shows the implied oil price of a whole range of companies based on the current market caps. So you can see that although they've come down, they've fallen from $75 per barrel at the beginning of 2015 to $63 per barrel now. Still, the market is not, if you like, accepting that this low oil price is here to stay. We'll see which way that goes as the year develops. But in M&A, timing is everything. And these two charts just show the value creation of two different time periods. The chart on the left shows value creation of deals done between 2002 and 2006 when the oil price was rising. And essentially you start off on the left-hand side, you start off with the deal consideration, so the price paid for the deal. That's $53 million for all the deals we looked at in that time period. We then look at the Wood Mackenzie valuation of those deals. That's running the Wood Mackenzie economic models based on the cash flows, based on the production, CapEx, OpEx, etc. And we had a slightly higher value at that time. So if you like, these deals were being done at a discount to Wood Mackenzie's valuation. But, 64 billion. Then you take away what the volume and cost changes, so your production and any increases in CapEx, which have destroyed value. That was minus 24. Then you add in the price changes, because the price was going up. That's a huge positive of 59. So in that period, these deals added value predominantly because the price went up. Simple as that. Contrast that with the majors value creation 2007 to 2011. We start off with the total acquisition deal spend, 48. That compared to the Wood Mackenzie deal valuation of 38, so they were paying a premium at this time to our valuations. Then you take away the volume and cost changes, which were minute,